Hey guys, Mike here. So today we're going to talk about some stocks and sectors that should do well during this kind of time or period we're in right now. And what I mean by that is we're going to focus on 2017, 2018, focusing on the NASDAQ, okay, because that one's more volatile than the SPY. And the reason why we're focusing on those 2 years is one, because it's in the 21st century, post-internet, and a lot of retail investors were involved in those 2 years. Two, we're going to be looking at it because 2017, 4 interest rate hikes going from 0.5% to 1.5%. 2018, this is the big one. You had 3 things going on. 4 interest rate hikes again, rolling of the balance sheet, right? Rolling off the balance sheet. And then more importantly, same thing we got going on this year, midterm elections. Okay, and if you didn't see my video on that, I'll put it at the end so you understand how the market performs during midterm elections, which is usually pretty bad until you get to a certain point in the year. So we'll see, okay? And so, a couple things to take away from this video, which, I like doing this kind of research to discover certain things. One, I will absolutely show you a pattern for a sector and their stocks that I did not know about before, and I told the members about it a couple weeks ago. And so I'm going to show you that because you're going to hear, and I'll go ahead and tell you it's the financials. You go, oh, when interest rate hikes are happening, financials perform great. And you look at the chart and you kind of go, really? You sure about that? But, and somewhat, but boy, there is a part of the year where for whatever reason, they really perform really well. And so I'm going to show you that. I'm going to show you another sector that just broke out last week, which I've been waiting on for a while. And so, and then third, when you look at the stocks I'm going to talk about, especially right at the beginning here, it should absolutely encourage you or in a way validate your thinking of your stocks that you've done your research on, that you feel good about, to hold on to them, right? And not just sell out of them and everything, because, when we go through the 2017 chart, you're going to say, oh man, those are mega cap names he's talking about. Well, remember, 5 years ago, guys, just 5 years ago, these stocks were not the big behemoths they are now, okay? And when you look at the returns on these stocks, you go, holy cow. Right, and so just think, if you hold at least for 5 years, you get to see what's going to happen. Of course, you can lose money. Again, not financial advice, just saying, but at least you should look at it and go, yeah, that makes sense to hold on as long as it's an investment you've done your research on. So, if you get anything out of it, please hit the like, subscribe button, notifications all. I really appreciate that, guys. For all of you that do that, it helps get the video out there. And so let's go ahead and start off with our favorite sector in stocks in the technology sector. And so here you can see what I was talking about. This is 2017 and 2018. I've listed out every single rate hike for you so you can actually see what I'm talking about. And that's a whole bunch of rate hikes. That's eight rate hikes in 2 years. And then rolling off the balance sheet in 2018, which basically caused that huge 24% drop in the NASDAQ. So if we go forward here, what you're going to see as we go and look at technology, the technology sector here, you can see, obviously, big move up in 2017, and obviously it's volatile as heck going in 2018. Major, I think it was like a 10% correction, 8% pullback, and then a 24% crash. And so you can see, but guess what? If you look at it going up to October, look how far up it moved, going from like 46 to around almost 72 bucks, right? And so what is this, ETF hold for you? What you're looking at here is 67% of the top holdings right there. Apple makes up 21%, Microsoft 20%, Nvidia, Visa, PayPal, MasterCard, Adobe, Intel, Salesforce, Cisco. So you've heard of all these stocks before. And if we look over how they performed during this time frame, you can see right here that they performed really well, okay? From 2017 until right before that crash you saw at the end of 2018, starting in late October. Look at these stocks right here. Nvidia up 178%, Adobe is 155%, PayPal is 121%, Salesforce 124%, Apple's up 100%, Microsoft's up 89%. So you can see they're all in different areas of technology is what I tried to find here for you. And so you can see they all did very well, even with interest rates going up 8 times, okay? Even with them rolling off the balance sheet starting in 2018, these stocks went up. And I know what you're thinking. You're like, hey, Mike, these are the big hitters. These are the big hitters you're bringing out. But not in 2017 and 18. You could get Nvidia for under 50 bucks in 2017. Tesla, which I didn't put on there, you get for pennies on the dollar All right, for Tesla. Tesla went up in 2017, got cut in half, I believe, in 2018. So a lot of people sold it in 2018. And look where it's at today. Adobe under 100 back then, right? PayPal much cheaper. You know, all these stocks were so much cheaper back then, obviously. And so that's what you got to keep in mind, okay? And so, you know, and like I said, they're in different sectors of the technology area, right? There was a fintech in there. Oh, look at that. They did really well. You know, here comes cybersecurity, did really well. You know, here comes Microsoft and Apple, which kind of do two different things, but somewhat similar. Boom. You know, they did really well, even with 8 interest rate hikes, okay? And running off the balance sheet, shocker, and a midterm election going on in 2018. So you see it can be done. Does it guarantee it's going to be done now? No, because you can't predict what the institutions are going to do. And there's a lot more, obviously inflation was not 8% back then, but you know, what is the market, you see the market doing right now? Trying to price in as much as possible, right? People hate to hear that, but what do you think this is? Okay, they're saying, oh, we're just going to ignore all the bad stuff. So, you know, at least you get to see that, and that's what I was saying, you get to look and go, wow, maybe I do need to hold my stocks if it's your conviction plays, right? And so that's one thing to think about. The other thing to think about too, obviously I just did this today, the Fang stocks, for example, I mean, almost every one of them except Microsoft, I believe it is, and Netflix, yeah, are approaching, you know, all-time highs, right? They're approaching their all-time high, and so the question is, are they going to bust through them, or are they not going to bust through them? Are they going to get rejected? And if they start to sell off, the market sells off because, again, with the Fang plus Tesla, you're looking at about 30% of the S&P, 45% of the NASDAQ at least, if not more, when you include Tesla, especially with this big run up. And so, you know, that's, you know, kind of an interesting spot to be in right now. But I sent out to the members this morning. The reason what's the X factor is this right here. I sent this to the members. And as we scroll down through the morning brief here, you can see cash allocations are almost 2 times more than last year's levels, according to new data out of Bank of America. The data looks at the average recommended allocation of stocks and cash by sell-side strategists. After recommended cash allocations hit a low of 2.5% last August, they have jumped 4.1% today. B of A says this is a big move. At the same time, sentiment on stocks has declined for 3 straight months as investors digest worrisome headlines on inflation, blah. While investors holding more cash appears like a negative for stocks at first blush, it's actually not historically, points out B of A strategist. What we have found is that consensus of Wall Street strategists are a very reliable contrarian indicator. Basically, when they're telling you to sell or everything's going to hell in a handbasket, that's when you need to be getting in. That's basically what they're saying. And of course, that's what you saw up, even though this might be, you know, some kind of bear market rally or whatever, it's such a huge move up. That lets you know it's just all that cash on the sidelines just started flooding in. The question is, will it continue to flood in, especially into the Fang stock, which is where it's really been going. A lot of it has, you know, to push them to all-time new highs and break them through that. And so that's kind of the X factor on that one. But looking forward, at least you can see this is not a month type of investment. As I showed you in the chart, that went from 2017 all the way to October 2018, that technology did really well, okay? And so the next one we're going to go into, and really a lot of these you're going to see, is things that you really just have to have, right? They got pricing power, that kind of stuff. And so the next one is healthcare, which has absolutely been pummeled so far at the start of the year, but starting to bounce back. And obviously we have to have healthcare, right? And you can see in 2017, really good year for healthcare. It is very volatile, okay? And obviously when the market crashed, it went right along with it. And with healthcare, you look at the top holdings of this ETF, and 50% of them are in 10 stocks. You'll recognize all of them: J&J, United Healthcare, AbbVie, Merck, Eli Lilly. And so a lot of these you definitely recognize, kind of spread pretty evenly across the board. And to me, I'm not going to spend a whole bunch of time on some of these sectors, because like with this one, like you really have to know what you're doing when it comes to which one of those stocks you want to pick out, or just go with an ETF of some kind. To me is much easier in this one. But if you know what you're doing in healthcare, or some people, they spend a lot of time researching healthcare. It's what they invest in, because you can make a lot of money in it. But if you think about it, no matter what's happening out there, got to go to hospitals, got to have your prescription drugs, you know, CVS's, the Walgreens, all that stuff. It's something to look at as well. And so that one's definitely one, and it was supposed to do really well coming in this year. It was projected to because of the rate hikes, right? And it just got slammed. So now you might see it start to take off, which has made a nice recovery from its lows. And so the next one, it really is to me the riskiest of all. And I really debated on putting this in here or not, but it's the energy sector, right? And this is the one that's been on fire for a long time right now. But if you look at 2017, 2018, you can see it was actually performed horribly, right? So the question is, well, why did it perform so bad, right, when everything else is going up? And obviously we scroll to where we're at now, and you can see, I mean, it's just killing it, right? I mean, a lot of people have made a ton of money, and this is one of those ones you got to be very careful and very selective. But the reason why I put it in here is because you can see when it does run up, especially oil and natural gas, seems to rarely happen, but when it does, it can go on for quite a long time. That's literally a 2-year period I just showed you right there. Okay, and so right now we're about a year and something into the run, and you can see this right here in this ETF, 77% of them are in these stocks, which you got to know the names of these, I'm sure. And you know, more importantly, if you look at the ETF and just show you what I'm talking about, I'll say, why does it go up? Well, I'm adding oil and natural gas in here, and these don't look like big moves by either one of these, but you can see obviously this is natural gas, or I'm sorry, this is U.S. oil, and you can see, you know, this thing went up 38%, and then we go over here to, you know, natural gas. Natural gas goes up like 88%, and so that's what drove obviously this ETF up and everything. But as you see, why did it do so bad in 2017, 2018? It's because U.S. oil going down. You know, that's what happened. And so now they're going up. And so that's why I threw it on here. But this one you got to be really careful of, because you've seen the big volatile moves. And so when it does drop, as you can see right here, this is where we're at now. You see all these commodities just skyrocketing. But you got to be extremely, extremely selective and careful in this one for sure. You know, and then moving on, you know, utilities. This is the one I've been waiting on for a while. I've been reading about this one. You see in 2017, made a nice big move up. You see big crash coming down into 2018, and then here goes another big run up, okay? And so, you know, when you look at this one thing you can tell about is it really, in a way, doesn't follow the market, right? Like the market crashed 24%, it crashed 10%, but then it just has these huge, huge swings, and I'm going to show you a more detailed chart. You'll get to see what I'm talking about. And when you look at, you know, what I've been following since April of last year on this one, I like to trade in these channels, right? And so, you know, break out of one channel, go into another one. So they've been quietly moving up since April, and you look right what's happening now. Boom, big breakout, right? So now I got to start a new channel right here. And so I've been waiting on that, but they've just been slowly creeping up. But look at the huge swings in this, right? I mean, it's following this trend line, of course, but there are some big swings on this one. And it's not going to be like some big tech returns on utilities and stuff, but it's just one of those things you got to have, right? I mean, you have to have utilities and stuff, especially with what's going on now, especially right here in the United States. And then, you know, if we just zoom in real quick, you can see that obviously broke out last week. It's starting to pull back now, which is what we were waiting on. Is it's going to come back. I mean, it shows you in every one of those channels the breakout, and then it, you know, trades back down. And you can see right here in this ETF, 64% of holdings right here. The one I read the most about is Duke Energy and Nextra Energy, and so that right there is the two I read the most about. So definitely be selective on those. I think they have good dividends as well. But, you know, the last one, this is one I'll show you a pattern on I discovered when I was doing a video for the members a couple weeks ago, is the financials, right? They say, oh, when interest rates go up, financials do great, you know, and you kind of look at it and say, yeah, I guess so. I mean, 4 interest rate hikes there, you know, in 2017. But then you go in 2018, you go, wow, we were pretty high interest rates going into 2018. They performed like crap. I mean, look at that. They went down from February 2018 all the way down into the crash. So they didn't do well at all, you know. But one thing I discovered when I started looking back at this, and I actually used the 3X ETF, the FAS, to discover this more. But when you look, you just go back and look at over the years of when does financials seem, or when does this ETF in particular, and when does the 3X ETF go up, which is what holds all of these financial institutions. You know, you look and it appears the last quarter of the year, right? That's from October going into next year. So boom, ends up spiking, right? That's 2016. Look at 2017, right? Last quarter, boom, big spike up, right? You go over to 2018, don't count again. Major crash. Everything went down. The whole market went down. But then we go over to 2019. Look what happens. Last quarter, huge move up, right? And if this ETF is going up, if the 3X leverage ETF is going up, that means the banking stocks are going up as well with it. That's what pushes it up like that. And when you pull up 2020, same thing, big move in the last quarter. 2021 was a little weird because everybody started rotating into the financial stocks. So they actually ran up nice all year, started to make that big move up, and then hit a bunch of volatility along the way. But, you know, looking from 2016 to 2020, it was the last quarter, except if there's a crash or some crazy mess we're going through now. And so, you know, keep an eye on that. You know, set your line for a breakout, see if that still continues. It looks like a pretty good pattern to me, but I just want to share that with you. And sometimes you run across stuff like that when you're, you know, doing this kind of research and stuff for you guys. But these are the sectors, the stocks that, at least according to the charts, have done well during these kind of times. Obviously, X factors like inflation being at 8%, oil being over $100, which you saw in 2017, 2018. It was not. Right, we hadn't had this whole oil of $100 since 2014, I believe. We don't have, you know, obviously Russia has the 11th largest economy in the world, and they're getting crushed and decimated, rightfully so, for what they're doing in Ukraine. So that's a whole nother issue as well. And so, you know, and then the other X factor is, like I said, when I send that out to the members, are the institutions going to take all that money and start rolling it in now because they feel like we're on the clock now that all of these you know, yield, 2-year, 10-year old stuff are inverting, right? Signaling a recession going from 12 to 18 months out or something. Do they feel like, hey, you know, we got to make the money now, right? Because we got to run this thing up. And we're going to see, right? We're going to see. And so these are things to keep an eye on. These aren't like day trade, swing trade, that kind of stuff. You saw that. I gave you 2 years of charts, right? 2 years to show you this. So it's just if you have, especially if you're in a lot of tech and stuff, if you have like a portion of your portfolio you're looking to put into something that maybe isn't as volatile, that does do well during these times, it's an idea. That's all it is, right? And so hope you got something out of this. If you like the daily updates you saw like that and private videos, hit one of the links down below, join up and stuff. Less than a McDonald's combo, as it says, which that's actually true now. It's actually half what a McDonald's combo is. So hope you guys got something out of it. Have a great day, and I'll see you tomorrow.